Hello, good morning. Good morning, everyone. In this short video, I'll share my views about this upcoming IPO SANSERA Engineering, which will be open for subscription from 14th September to 16th September. I'll just give a brief about the what are the positive points in this company and what are the risk factors in this company. The first we'll see the analysis IPO logic, what they should have done and what they are doing, and what is the comment, what is their comment for this. So the first factor is relevant factor is capital intensive industry. As this company called as SANSERA Engineering is supplying components to the automobile sector, it is a highly capital intensive industry. More than 65% of their total assets are in the non-current assets. Okay, so therefore it's a very capital intensive industry. Everyone knows that automobile business is not a small thing. It requires huge capital, huge technology, etc. So if that is the case, they should have utilized the IPO proceeds for capital expansion. But what they have done with that, they are giving partial exit to the financial investors, and they are also slightly reducing the promoter stake. Not only giving an exit to the financial investors, even the promoters are reducing their stake in the company. That is one thing to be worried about. And the next point is that normally automobile is capital intensive sector. Apart from that, over and above that, now during the because of the emergence of electric vehicle segment, they are supposed to invest more money, which they agreed, which they thought, which they explained that yes, they have a big plans about the electric vehicle component manufacturing. But if that is the case, they should have utilized the IPO proceeds for latest equipment, machinery, etc., which facilitates for electric vehicle component manufacturing. But they are not doing that. That is one thing. And the automobile sector is very cyclical. If our business is very cyclical, it is advisable to keep the debt as low as possible. But whereas they are keeping the reasonable amount of debt, no doubt the debt equity ratio is 0.5. But still, they have some debt in the balance sheet. There, it is advisable to reduce their debt, and considerable debt in the balance sheet. It suggests them to reduce the debt. But in fact, what they are doing is that they are not reducing the debt. They are just giving an exit to the financial investors. So this is what my observations. What they're actually doing is they are giving a partial exit to the financial investors, and they're also partially reducing the promoter stake. So for this, what is the comment given by the promoters? The promoters has given a comment that financial investors have their own reasons. There may be 101 reasons why the financial investors will exit from the company. Financial investors, unlike strategic investors, they are not committed to stay with us for a long period of time. They might not have adequate patience to wait for 3 years or 4 years as to see how the things will turn up. They may have many reasons or many pressures to exit from their investment. Yes, it is highly acceptable. Yes, it is reasonable. Yes, you have to give an exit to the financial investors. Yes, that's fine. But the worry point, but the concern point is that why the promoters are also reducing their stake partially. Is it that they have plans about the future rights issue? What is that? That is not clear from why the promoters are reducing their partial stake. Why the financial investors are exiting partially? That nobody knows. It is their personal their reasons, their business reasons, their restrictions from the investors or their pressures from the investor. That's fine. But what is worrisome is the promoters are also reducing partially their stake. That is one concern. And the promoters has given the comment in their interview saying that a capital expenditure will be funded from the internal accruals. Capital expenditure will be funded from the internal accruals. So the second point, capital expenditure can be funded from internal accruals. That is also not reliable according to me. That may not be feasible, because if you look at the last 3 years, their investment, their average investment is more than 1,000 crores, but the cumulative cash and cash equivalents is hardly 650 crores. Most of their internal accruals has been already blocked in the inventories and receivables. They don't have much free cash to spend for the capital expansion. So therefore, I'm not sure how they are going to fund the capital expansion with the internal accruals, which is very less. And most of the internal accruals are already blocked in inventory and receivables, no much cash reserves. So it may not be possible to fund the capital investments from their internal accrual. So therefore, these two are worrying. First one is promoters reducing their stake partially and funding capital expenditure from internal accruals. These two may not be possible. So these two are worry points about this company. And next, when it comes to the risk factors, about 85% of their revenue is from domestic sales, which is very risky. We know that now after slowly easing the COVID restrictions, India is not as stabilized as the developed countries. So therefore, given the current scenario, those who are primarily dependent on the exports may be benefited, and those who are primarily dependent on the domestic business may be partially affected. Therefore, it is one worry thing. Their exports is not substantial. Only 15% is their exports. Majority of their business is in domestic. And next point is that inability to pass on increase in input cost. As their sales are concentrated to few customers, when a customer buys a bulk amount of products, obviously he will bargain for a lower price. So this company sells its components to the Bajaj Auto or to the Maruti Suzuki, which they will bulk purchase in a bulk quantity, obviously they will bargain for the lower price. They will bargain for the lower price. In the given case, the concept called as economies of scale is turning to be adverse to this company. The customers are having more bargaining power, therefore they are unable to increase their prices, increase their component prices. In spite of increasing in their input cost, they are unable to pass on that increase to the final sales price. That may put some pressure on their margins. That is one reason. And piling up of receivables may restrict cash availability. As I already told you, so there are more receivables and more inventories get blocked. Therefore, it may not be possible to you to get free cash for funding future expansion. So these are the risk factors. So positive factors, yes, every company has their own risk factors and positive factors. When it comes to the positive factors, they have around 4 decades of experience. They have been established in 1981. It's not a new company to be worried about. Yes, they have good amount of reasonably or highly reasonable good amount of experience. They have almost 4 decades of experience. And not only the companies in existence for 4 decades, they are also having long relationship with the major customers like Bajaj and Maruti. These are also good sign. And they prefer to use internal accruals rather than the debt. They said, the promoters have given an interview that their primary preference is to use the internal accruals for funding their expansion. If that is not possible, then only they will go for the debt. That is a positive thing from the promoter side. So therefore, the first 2 points is a favorable points in favor of this company: experience, long-standing experience, and long-standing relationship with the customers. So we have both negatives and positives. So therefore, what is my final advice? According to me, finally, there may not be much listing gains because the price is already high. The offer price fixed is already high. Therefore, they may not. There is less possibility of listing gains. Even if you got the listing gains, also very small. It may not be drastical like how you see in the other IPOs. Therefore, that is one reason. And my final advice is that better to wait for 1 year or 6 months or 1.5 years to see how this electric vehicle business will evolve and how the automobile sector is going to capture that trend. So we have to wait and see, and how the third wave, how we can overcome the third wave, and when the effects of all this corona lockdown will be completely closed. So that there are many things which we have to wait and see. The price is not very less, so that we can rush to purchase the stock. Just wait and watch. If you still don't want to miss out any listing gains, my advice is purchase 1 or 2 lots, not much more than that. Okay, but wait for 1 year, at least for 1 year, wait, so that we can see how the things will evolve. No doubt, the company is a very good company. The company is fundamentally good company, long-standing relationship with the customers, and also 4 decades of experience. No doubt at all. Absolutely, the company is good. But the point is that it is not the right time, and the IPO offer price is not the right price to enter. So 2 points you need to remember: every good company is not a good investment. So this, everyone who is investing in the stock market, they have to fundamentally remember this concept. Every good business is not a good stock. No doubt this company is a good business, but it's not a good stock at the offer price. At the present IPO offer price of around 740, it's not a good price. Therefore, company is good, but the timing is not good. Wait, we'll see whether the price will get corrected, or whether they will improve their balance sheet, and whether they will slightly change their business model to adopt to the trends. So based on how the things evolve, it's advisable to plunge into the investment. Okay, thank you.